We ran sector-adjusted momentum on 14 stock exchanges from 2000 to 2025. One market compounded at 18.54% annually. Another returned 1.61%. Both used the exact same signal. The difference wasn't the formula, it was the market. The setup is the same framework we use across every strategy in this series: universe, signal, rebalance, measure. Universe: all stocks on a target exchange with market cap above a local threshold and a known global industry classification standard sector classification. We need the sector data for the relative strength calculation, so any stock without a valid sector drops out. We also require at least 5 stocks per sector at each rebalance date to compute a meaningful sector average. Without that 4, a sector with 2 outlier stocks produces a nonsense average and a nonsense relative strength score. Sector classifications change over time. Facebook moved from technology to communication services in 2018 when GICS reorganized. We use the classification as of each rebalance date, not today's. That avoids look-ahead bias in the sector assignment. 3 exchanges were excluded before we started: Norway, Italy, and Singapore. All 3 averaged fewer than 5 active sectors per rebalance date. The relative strength signal is mathematically meaningless without sector breadth. There's no point running the test. The benchmark is the local index for each exchange: S&P 500 for US, Sensex for India, DAX for Germany, and so on. Transaction costs are 0.1% per trade. That's a rough average, but because relative strength portfolios are expected to have lower turnover than raw momentum, the cost drag should be smaller here than in the raw momentum results. Each quarter, at the start of January, April, July, and October, we do the following for every qualifying stock in the target exchange. Pull the adjusted close price on the rebalance date and the adjusted close price 252 trading days earlier, roughly 12 months back. Compute the stock's return over that window. Group the qualifying stocks by sector and compute the average return for each sector. The stock's relative strength score is its return minus that sector average. Rank all qualifying stocks by that score. By the top 30, equal weight at roughly 3.3% each. Sell the prior quarter's holdings. Measure what happens over the next quarter. The signal uses the 12-1 month return, 12M times 1M. The price from 12 months ago to 1 month ago, skipping the most recent month to avoid short-term reversal contamination. This is the same convention as the screener, and it matches the Jagadish Tipman 1993 framework. The sector adjustment removes sector-level noise, but does not substitute for the skip-month reversal filter. Rebalancing is quarterly for the same reason it is across the rest of the series. Monthly rebalancing generates too much turnover and erodes returns through costs. Annual rebalancing is too slow to capture the signal refresh. Quarterly hits the right trade-off, and relative strength portfolios should see lower turnover than raw momentum in any case, since sector rotations that force complete portfolio rebuilds in raw momentum only partially affect a sector-adjusted strategy. Here are the full results across 14 exchanges. 11 outperformed their local benchmark. 3 underperform. The split is clean, and the dividing line isn't what you guess from the signal alone. The single best result is Sweden, 8.28 percentage points of annual alpha over the OMX Stockholm 30, at an 11.48% compound annual growth rate and a 0.457 Sharpe ratio. Sweden does it with only 6.4 active sectors per rebalance, which already tells you sector count alone doesn't decide the outcome. The strongest result by absolute return is India at 18.54% compound annual growth rate, 7.42 percentage points of annual alpha versus Sensex, and a 0.427 Sharpe ratio. Down capture of 82% during quarters when the Sensex fell. That's a meaningful reduction in bear market losses while compounding it well above the local benchmark rate. Those two things don't usually happen together. Germany has the best risk-adjusted developed market result, 10.99% compound annual growth rate, 5.87 points of annual alpha versus DAX, and a Sharpe of 0.478, the highest in the study. During bear quarters, the German strategy absorbed about 54.55 cents for every euro the DAX lost. Etc. averages 9.0 active sectors per rebalance date, the highest of any exchange. With that sector breadth, each stock's relative strength score is meaningful within a genuine peer group. Then there's the US, and as the most misread result in the set. On raw return, the strategy beat the S&P 500, 9.46% compound annual growth rate against 8.02%, a 1.45-point edge. A dollar grew to $10.26 versus $7.28 in the index, so it wins, right? Look closer. The Sharpe ratio is 0.248 against the S&P 500's 0.361, so it's worse per unit of risk. The max drawdown is 59.9% against the index's 43.9%. The beta is 1.46 and Jensen's alpha is negative at -1.3%. Down capture is 146.9%, the worst in the entire study. The U.S. portfolio fell far harder than the market in bear quarters and rode a 60% drawdown to get its raw return edge. That extra return isn't skill, it's leverage. The honest read, sector-adjusted momentum beat the S&P 500 on paper, but there's no risk-adjusted edge here at all. The results don't break along one clean dimension, and that's the honest finding. Sweden is the single best result with only 6.4 active sectors per rebalance. India averages 9.5 and Germany 9.0, both strong, but Sweden's edge says sector count alone doesn't predict success. In the markets where relative strength works, India, Germany, Sweden, the UK, what remains after you strip the sector effect is genuine stock-specific momentum driven by company fundamentals and market recognition. That signal persists because it's harder to arbitrage in markets with thinner analyst coverage and slower information diffusion. The three failures share a clearer logic than the winners do. Japan and China are Asian markets with strong sector co-movement, so there's less idiosyncratic momentum left once you remove the sector. South Africa fails for a different reason. It has only 3.7 active sectors, far too thin for the peer group math, and with no local JSE index in the data it's benchmarked against the S&P 500, a high hurdle that few markets clear. The US is the case that's easiest to get wrong. On raw return, it beats the S&P 500, 9.46% against 8.02%, but its Sharpe is 0.248 against the index's 0.361. Its drawdown is 59.9%, and its down capture is 146.9%, the worst in the study. The beta is 1.46 and Jensen's alpha is negative. The US doesn't lose to the market on the scoreboard, but it adds no risk-adjusted value. The extra return is leverage, not skill. Down capture tells the deeper story. Germany's 54.55% and Korea's 54.77% mean those strategies absorb less than the local market in bear quarters while delivering higher returns. At the other end, the US at 146.9% falls far harder than the market, which is exactly why its raw return edge doesn't survive a risk adjustment. This pattern isn't coincidental. In markets where relative strength works, the selected stocks tend to have fundamental business momentum backing the price momentum. In panics, that fundamental cushion matters. In the US, the selected stocks are the most crowded, highest beta momentum positions. They get sold first when markets turn, and the sector adjustment doesn't fix that. The exchange exclusions before the test started also tell a story. Norway, Italy, and Singapore were dropped because they couldn't sustain 5 active sectors. The signal genuinely requires sector diversity to function. That's not a filter you can work around. It's structural. A few things no amount of signal refinement can fix. The strategy needs sector diversity to function. Markets averaging fewer than 5 active sectors can't support a relative strength screen. This is a structural requirement, not a parameter you can tune. The sector adjustment doesn't protect against momentum crashes in general. It reduces the sector concentration component of crash risk. But concentrated momentum portfolios across any dimension can draw down hard in panics. The US result, a 146.9% down capture and a 59.9% drawdown, is evidence that removing sector concentration doesn't solve the problem when the broader momentum factor sells off. The 0.1% transaction cost assumption may understate real-world costs in thinner markets. South Africa, for example, carries lower liquidity than Germany. Real implementation costs for the top 30 stocks on the Johannesburg Stock Exchange will differ from the top 30 on etc. The backtest uses the GICS sector as reported, which can lag actual business changes. A company that pivots substantially can carry the wrong sector classification for several quarters. In markets with frequent business model shifts, that classification error introduces noise into the sector average. Finally, 25 years of data on 14 exchanges is a large sample, But emerging market results from 2000 to 2003 reflect thin liquidity in some cases. India had 18 cash quarters in the early period when not enough large-cap stocks qualified. The long-run results are real, but the early years in emerging markets should be read with that caveat. 11 markets outperformed their local benchmark over 25 years, using a signal that's one sequel join more complex than raw momentum. The full results, charts, and code are on the blog at cetaresearch.com. Link in the description. The Relative Strength series continues with a look at combining sector-adjusted momentum with quality filters. If buying stocks that beat their sector produces alpha, buying stocks that beat their sector and have strong fundamentals is the next question. Subscribe if you want to see the data.